Hello everyone. In this video, I will be solving question number 2 of SBR pre-June 2026 mock exam. The purpose is to solve it fully time-bound as a student would do. The aim is not to have a perfect answer, but to go through the approach of answering the question and to produce an answer which can score good marks. We will be finishing ideally between 30 to 35 minutes. That's the recommended time for question 2 of SBR. Okay, so we'll open the answer space and adjust it, and then open the requirements, copy all of them, and paste it in our answer space so that we don't have to come back to requirements again, and we can maybe slightly arrange it. So that we are able to answer it properly. We can create some space between each requirement. I can see a lot of requirements here for small marks. And I can see that ethics requirements is just for 5 marks. This is a bit surprising because in the recent history, um, we all know that question 2 is basically an ethics question. It has a part requirement on ethics, but in the recent past, it has been at least 7, 8 marks or 10 marks plus 2 professional for ethics requirement. But this one is 5, quite a low number of marks as compared to some of the recent sittings. But anyways, we will start reading the requirements. First step is to read all the requirements, and then we will go through and read the exhibits. Discuss whether the property meets the definition of investment property in Koina's separate financial statements and Pavana's consolidated financial statements, and explain how changes in fair value should be reflected in the financial statements. So now this requirement has a few parts. It's 4 marks, and I can see 4 different aspects being talked about. First of all, they're asking about some property being meeting the definition of investment property, which refers to IAS 40. In Koina's company's separate financial statements, that means their individual financial statements. So I'm taking that as a heading because that breaks down the question and makes it easier to break down the marks also and points also. So the second one they're asking in Pavana's consolidated financial statement. So let's take that as a heading also. And in them also they're asking about 2 things. One, whether it meets the definition, and the other, that how changes in fair value should be reflected. So definition and changes in fair value. And same they're asking here also. So it has already been, you can say, divided it to 4 points here for 4 marks. Then discuss whether the trainee's assertions regarding the useful life of assets are correct. So again, useful life is there in IS 40 also, IS 16 also, and it has a connection to depreciation. So maybe something on that. Discuss whether inventory write down is a prior period adjustment. Again, IAS 8 prior period errors, and there is also inventory write down, maybe IS 2. So while doing a question, we have to, while reading the requirements or exhibits, we have to bring in mind the relevant standards which might apply. Discuss how the loan notes should be accounted for by Pavana company. Now, loan notes takes me to financial instruments, maybe IFRS 9, something like that. And then discuss the ethical issues arising from. So I give here a heading. There are professional marks also, so it's better to divide it into heading, and heading makes things easier also. Discuss the ethical issues arising from the scenario which Ms. Patel needs to consider, and what actions she should take as a consequence. So actions to take for Miss Patel, and ethical issues to be considered by Miss Patel. Something like that. We make the headings just by reading the requirements if needed. Very less marks are here, 3 marks, 3 marks. So that means I'll try to write each point for a mark separately. Now let's read the background information here and then we'll go to the exhibits. Pavana Company manufactures and distributes products throughout the world. It has properties in many different countries and prepares its financial statements in accordance with IFRS accounting standards. The year end is 31st December 2009. It has properties in different countries, and they were referring to some investment properties as well. So there are two exhibits which we will read from here. Now we open the first exhibit and maybe start answering. So now, immediately what I saw by opening it is that there is a heading here, investment property, which is related to investment property here in A1. Then you have useful life of assets. So here you have useful life. Then inventory write down. The third requirement was inventory write down. And then loan notes. The fourth requirement in part A is loan notes. So this means we have to read the para and then answer each of these requirements. And then ethical requirement might be related to full discussion here. And also there is another exhibit here. I can see something on bonuses, which might have a link here on ethics. So a trainee member of the accounting department has proposed to Ms. Patel, the head accountant and an ACCM member. Now, this is relevant here. I can write here, Ms. Patel, uh, head accountant. I'm not writing fully at the moment, and ACCM member. Later, I'll come back to this. A number of initiatives aimed at increasing Pavana Company's profitability for the current period. So, trainees proposing to head accountant some initiatives at increasing profitability. This is a bit questionable because how can a trainee propose to head? Maybe he's some technical qualified person, but we're not sure. They've not given any detail. The trainee is the nephew of Pavana Company's chairman, whose annual bonus is based on reported profit. Nephew of chairman, bonus linked to profit. So this then raises some ethical concerns because maybe chairman has influence, obviously, and these proposals might be focused on maybe trying to improve profits, something like that. You have to think about it while you see some point, but we will find out when we read further. So the initiatives proposed by trainee accountant are as follows. Now we focus here on A1, investment property. A property owned by Koina Company, a subsidiary of Pavana Company, should be classified as investment property. This is what trainee is saying. Um, and obviously, this means he's referring to consolidated financial statements. The property is rented to Lagone, another of Pavana Company's subsidiaries. The trainee accountant argues that by classifying the property as investment property, any gains in value which will be included in profit or loss, but any fall in fair value can be deferred by included in other comprehensive income. First of all, this treatment given by him as per investment property IAS 40 is incorrect because in investment property IAS 40, uh, gains or losses go to P&L in fair value. So this is not correct. You know, actually, this type of a treatment is in I-16, but in that case also the gains, the losses are first adjusted against the gains in OCI, and then excess goes to P&L. So this treatment is not correct under any applicable standards. And another thing is that he's saying that it should be classified as investment property. Now, Koina is also a subsidiary of Pavana, and to whom they have rented, Lagone is also a subsidiary. So that means they've rented it within the group. Now, if we think from Koina's separate individual financial statements, so then yes, because Koina is a separate entity from Lagone and they've given it on rent. So obviously, if they meet the recognition criteria of investment property, then which rental property does usually, but there has to be a reliable estimate and probable inflow. So then in that case, it will meet. So they're asking about the definition of investment property. So for that, we can say that um, Koina is renting out a property to Lagone uh, which is a separate entity from Koina. So in the individual separate financial statements of Koina, uh, this property meets the definition of investment property as Koina is earning rentals from renting this property to a separate entity. So now they're saying the other part that they were asking is how changes fair value should be reflected in financial statements. So uh, the property will be treated in separate financial statements of Koina as per IAS 40 if it meets all the recognition criteria like probable benefits, probable inflow of economic benefits, and reliable measure. um, being available. Fair value gains or losses are measured at each year end, and the gains at year end under IAS 40 and the gains year end under IAS 40 and the gains and losses are recorded in P&L. For Pavana companies' consolidated financial statements, both Koina and Lugone are subsidiaries of Pavana, which means the rental of property from Koina to Lugone is within the group, and that means no rental income is generated from outside the group. So for group accounts, it cannot be treated as investment property because for that, when you are preparing group accounts, you have to look at group as one entity and then see whether the rental is being incurred from outside the group. Now, changes in fair value, this property might qualify under IAS 16 um, because it is if it is used for business or administration purposes within the group. Production, supply, etc. In that case, the changes in fair value have to be made at year ends and gains or losses if fair value model is used. Let's refer to the model also. And here we can say, in that case, if revaluation model is used, the changes in fair value have to be made at year ends, and the gains or losses are and the gains are recorded in OCI, and losses are first adjusted from any existing gains in OCI, and is taken, excess losses are taken to P&L. Trainees argument is incorrect for the treatment of fair value gains or losses and might lead to overstatement and being. Okay, so this is over. Now, useful life of assets. The useful life of all plant and equipment should be increased from. So they're asking whether the trainee's assertions regarding the useful life of assets are correct. Here you saw we put 4 points and we're done. 1, 2, 3, 4. I did refer to trainee's argument here and did a bit more, but it's better to refer it because his argument was not correct. Okay, now we go on to solve the next one, which is on useful life. They're saying discuss whether the trainee's assertions regarding the useful life of assets are correct. The useful life of all plant equipment should be increased from 5 years to 10 years. The trainee argues that this will increase the annual profit dramatically as the asset has already been paid for, and no one is bothered about how much depreciation is charged for the assets. So, trainee uh, has proposed to increase the useful life of plant and equipment. Accounting standards allow a review of useful life at year ends, and if justified, then a change in useful life uh, estimate should be made. It is not clear, it is not clear whether there is a valid justification available to increase useful life. If useful life is increased, then that would mean uh, depreciation would reduce, uh, and that will be a change in estimate as per IAS 8 and has to be applied prospectively from this year and onwards. That means depreciation would have to be calculated on remaining updated useful life and will be charged to current year P&L. Profits will increase because of lowered depreciation expense. If useful life increase has a valid justification, profits will increase because of lower depreciation expense. So training is correct in that regard, but his argument that no one is bothered about depreciation is not correct because it affects profits and stakeholders are interested in profits. Okay, so I think that's enough for 3 marks. Now we go discuss whether the inventory write-down is a prior period adjustment. Classifying a large write-down in inventories that occurred in current period as a prior period adjustment. So this is his proposal. The trainee argues that the inventories were probably impaired over 12 months ago in the year ended 31st December 2008, and therefore it was a mistake in the prior period not to write down the inventories. Now, again, this word probably is not sure. IAS 2 requires inventory to be valued at lower of cost or net realizable value, NRV, and if NRV is lower, then a write down in inventory value is required. But there has to be a strong evidence that uh, right NRV was lower than cost in last year for this to be considered as a prior period error. Um, just on the basis of probability. Uh, it cannot be considered a prior period error. Another thing is that if there is evidence of an error in last year, then this will be treated under IAS 8 as prior period error and will need a retrospective adjustment because IAS 8 requires retrospective adjustment in these cases, as if the error never happened, which means inventory value might have to be adjusted and the adjustment effect will be reflected or adjustment will happen from the opening balance of retained earnings in the current year. The error was found. Error is found. Okay. Or let's keep it till current year. That's fine. So we've got the 3 points here. Now we go on to the next one. Loan notes. Recognizing a substantial discount on loan notes acquired in the year as income in profit or loss. The loan notes were issued by one of Pavana company's suppliers. The supplier had been experiencing significant financial difficulty, which explains the deep discount below nominal value on issue of the loan notes. So he's saying you have to record the discount on loan notes as income. And this, because they're saying there was a supplier had experienced significant financial difficulty and loan notes were issued by supplier. So that means Pavana gave the loan. It's a financial asset for them. And if there is an experiencing financial difficulty, that refers to impaired loans. So the loan issued by supplier to Pavana is a financial asset for Pavana as per IFRS 9, and because the supplier is experiencing financial difficulties, was experiencing financial difficulties, this will be a credit impaired loan. Now, trainees are proposal that uh, loans should be recognized initially at nominal value minus uh, initially by recording the discount as income is incorrect, because IFRS 9 requires such credit impaired or such financial assets to be recorded at their fair value, uh, and not on which already takes into account fair value, and does not require discount to be recorded as income. Uh, Actually, fair value already takes into account the effect of discount and any impairment, as the market is aware that it is a credit impaired loan. So there will be no need to calculate impairment at the time of recognition of this loan. Impairment will be determined later on the year ends as part of subsequent payment. Now let's go to ethics part. So we'll start with this point. Ms. Patel is a head accountant and an ACCA member, which means she has a duty to comply with code of ethics, as stakeholders will rely on her work while taking decisions. So this can give you 1 mark. Now, let's read the second exhibit. We should not miss that. After the trainee accountant proposed the initiatives, an email was accidentally circulated around the company stating that if the initiatives were implemented, the trainee would receive 20% of any bonus paid to chairman. So let's keep this point first. 20%. Trainee is expected to receive 20% of any bonus paid to chairman, and chairman's bonus is linked to profits. This clearly creates a self-interest threat on the objectivity of the trainee, as he might have made recommendations which increase, uh, which are aimed, which might be aimed to increase profits in order to get high bonus share. Trainee is also a nephew of chairman of the company, which creates an intimidation threat on the objectivity of Ms. Patel, as she might be under pressure due to the seniority and influence of chairman, and might end up accepting the proposals of trainee, even if they are not reflecting uh, accounting standard requirements. So now actions to take for Ms. Patel, because we've got 3, so let's keep 2 marks for actions. So we'll say Ms. Patel should not be pressurized in this situation and should analyze professionally the proposals and before taking any implementation actions. Ms. Patel, if Ms. Patel feels the proposals are not as per accounting standards, then she should not implement any proposals and should explain the ethical concerns to the chairman. Another thing is that Ms. Patel let's keep it till here. Ms. Patel should, because directly Ms. Patel talking to chairman is not appropriate, so we can say discuss the ethical concerns with her senior, like finance director, and so that finance director can take appropriate steps to appropriate steps. So that's fine. Uh, I think that's enough for this question. We have completed it within around 30 to 35 minutes, as I said. So that's your answer for question 2.